Into the Gnar, where the cutting edge of software gets built. We're going to talk about real builds, real decisions, real consequences, the moments where things went sideways and how they got back on track. You don't have to cut corners to move fast. You need great people, you need great process, and that's what creates speed in the end.
One bad line of context is probably 100 lines of bad code.
We spent the last 10 plus years building software for companies of all sizes, from scrappy startups to $100 million operators and beyond. The gap between how software gets talked about and how it actually gets built is where most of the damage happens. This is Into the Gnar.
2 weeks ago, we talked to Cam Salem, and he gave us investors' read on AI spend. Last week, we talked with Frank Granera. He gave us the buyer's read. Today, it's just going to be me and Nick, and we're going after a number that almost nobody in our audience has, and it's tracking AI spend. So let's get into it. Welcome back to Into the Gnar, where the cutting edge of software gets built. I'm Mike Stone here with my co-founder and co-host, Nick Maloney. As I mentioned, today's a solo one. It's just the two of us, and we're doing something that we've been circling for a while. A study landed this morning. 150 leaders were asked whether AI had cut their losses. Zero, not one of them said yes. 2/3 said their costs went up. So if you bought AI in the last 18 months, and who hasn't, but you couldn't tell your CFO what it's running you per month, this is for you. Let's get into it. All right. 2 episodes back, we had Cam Salem. He's the founder of Headlight Partners. They're a growth equity firm and a very concentrated version of it. He and his partner, Jack, do 1 or 2 deals a year on purpose because they actually want to be useful to the founder instead of showing up at the board meeting. And Cam said something in that conversation I've not been able to put down. We were talking about where AI pricing is going to go. And he said that at the moment, it's a little bit of a black box. So this is a professional investor. His job is knowing what things cost. And his answer is what I think everyone's feeling right now is nobody knows yet. So Nick, you had mentioned in that episode that we're capturing AI usage data now so that when the pricing shifts, we can look at historicals. Has that paid off at all yet?
And I'm curious when and if it will. I think it will. But we actually were in a meeting today discussing that exact topic. And just as a bit of a background for our listeners, we developed some tools based on OpenTelemetry, which is a standard for log data, telemetry data, and software systems. And Claude makes that information accessible so that you can monitor your usage. And we built a platform that collects that, and it also allows us to tag it so that when our team is, say, using Claude Code on a specific project, it knows Claude Code is churning token within that project. And over time, we can approximate how much usage on a specific project we're using. And in theory, calculate spend, cost of goods sold, all of that fun stuff. And the tool itself works as intended. We've got this great dashboard. We can drill down, see how many tokens folks are using. But what we're finding is the data in there is not as useful as it could or should be. And I have some unsubstantiated hypothesis as to why, but it doesn't make it as useful. What we have in there is overall spend and overall token usage. But that doesn't take into account if you have a subscription. It's really how much this would cost if you weren't subsidized by subscription. And that isn't super helpful to us because it is being subsidized. So we might see this really big number, but it's not actually what our spend is per project. And is Anthropic doing that to prepare you for what the future holds, in that they're eventually going to take away the subsidized spend and they want you to track it? And this is what it would have cost you if you were just doing token-based usage? I don't know. And that to me is the biggest gap, where we can't accurately predict COGS. And we actually had the meeting today where we have an action item where we have to figure out, do we have to run through gymnastics where we have to look at licenses, subtract the subsidized cost from the total cost to then compute it? I don't know yet, but I think once we do have our arms around that, it's going to be helpful for us just to figure out what pricing costs. But it's not helpful for larger organizations or organizations that don't have the metrics that we do. Our business model is very simple, where our input is employees and then whatever tools and other costs that go into a project. And then our output is what we bill the client, and we need to calculate those costs. But if you're going into it and let's say you have an initiative for your company, a project, and you're not tracking any metrics, like all you're seeing is what your Claude spend is, but you're not able to quantify what the value is in there. And that's the blind spot that I think a lot of orgs have. If you really want to track this, you need KPIs and metrics to track against it. Otherwise, your only lens is your Anthropic bill, and it is going up, and it's not great, but it's offsetting. You're getting more efficient labor costs, more productivity, maybe fewer defects, fewer bugs. But unless you're tracking that, you're only going to see that number go up and up. And I think companies need to be more deliberate in setting those processes up, especially now, because we're going to be using more and more of these tools as time goes on. And if you don't have that infrastructure or processes in place, you'll never justify the costs. And I think that's something that more companies really need to stay ahead of. And I'll pause there because I rambled for about 10 minutes, but I was talking about this for 2 hours today.
No, I mean, to me, this is the most disappointing thing to me of adopting Claude. I think everything with how the LLM works has been great. We've been able to leverage it to great value for our clients and our internal use, but it is shockingly bad on the data that it reports. And for a company that's focused on B2B and capturing that market, the data that comes out of the box from Claude is so bad and so high level and not really useful at all, forcing us to build this open telemetry dashboard where we can get it. It's not like the data isn't available. Like there is this exhaust from LLM use that you can harvest. And so we know token spends and we know the equivalent dollar value, like you mentioned, if we were to be using their usage-based pricing, but there isn't a way to know exactly what our spend is, where like other tools have that. When we used Cursor, they had that. They said, this is what's included in your subscription, and this is what this person or this project went over that. And I think we'll start seeing a lot more products around this. I believe Cam Salem and Headlight invested in NOps in part for this, where they help you reduce your spend and then kind of take a cut of that spend reduction. But I'm sure they're focusing more in this area. And so it's a frustrating black box that exists right now.
Yeah, but I think 2 follow-up items are the lens that we're looking at it from is different than larger orgs. I don't recall the seat count, but it's fairly limited. So enterprise orgs aren't eligible for the per seat subscription model that we have. It's really SMB. They're straight up enterprise, and that's token-based usage only, which is much easier to track, but it's also orders of magnitude more expensive. So I'm curious what their play is, if they're just trying to subsidize the smaller orgs in the hope that you either matriculate into spending a lot of money or you become champions for the product. And then as your career evolves and you go into these larger orgs, you bring Claude with you. I'm not sure. And one other tangent, but I think it's relevant and it's like a hot off the presses, is Stripe just bought OpenRouter, and OpenRouter is a platform for LLM routing. And that gives you a lot of visibility into spend, usage, everything. It's a critical tool. And I mean, it's interesting that Stripe bought it for $7 billion, but that gives them a seat at the table for many large orgs LLM usage, spend, infrastructure. And I think they're planning ahead for having a seat at the table for monitoring and whatever other directions the industry goes in with how we implement LLMs. So I'm paying close attention to where that goes. And there's other alternatives like Cloudflare, for instance, has a really good baked in LLM router that I think we'll ultimately plan on using. But from our spend perspective, leaves a lot to be desired. And I think a lot of other orgs are feeling that pinch.
I remember when first off, great prediction. It's shocking to me that you don't see any of these blockbuster investments in the millions anymore. They're all multiple billions, which is just crazy to me. And it's a little bit of a curious investment, but I'll be checking in on that too. I like that. I hope that's what they do because, they do a good job with their tooling. Of course, now I just lost my train of thought. Oh, no. I remember when we were looking at using OpenRouter and some of those other tools, by using them, you have to use the per usage token model. So you can't use the subsidized subscriptions, which was just a no-go for us. And I'm sure many companies like us.
Yeah. I mean, my other rant on that theme too is I was a huge user of OpenClaw, and it to this day was a lot more capable than Claude Desktop. And the fact that I think because it was churning through so much tokens, you can't use it without token-based pricing anymore, speaks volumes too. But it makes me sad. I tried to plug in Gemini, but not nearly good. But I hope they step up to the plate and start to port in some of the functionality that OpenClaw provided in Claude Desktop.
Yeah, I miss old Morty, my Molt bot. That was a fun era.
I bet the market for used minis is insane right now. I had Pinchy mine, but everyone bought a Mac Mini to run OpenClaw, and now you don't hear that as much.
I got mine right over there. But yeah, I've been trying to think, what should I use this thing for now that I can't run Mortimer?
Hey, it's Mike. Before we continue, thank you for being here. Into the Gnar exists for one reason: to cut through the noise around custom software development and give you something actually useful. We want to build a community around that. So if something in this episode hit, or if there's a topic you want us to go deeper on, leave a comment. It genuinely shapes what we'll make next. Also, if AI is on your roadmap and you're not sure if your team's set up for it, we made something for you. It's a free 2-minute assessment over at thegnar.com that tells you exactly where you stand. Link is in the show notes. All right, back to the conversation.
All right, so moving on. That was from the investor side with Cam. Last episode with Frank Gnar, CEO of General Insulation, 50 branches, installation on commercial job sites by 6 a.m, and he told us exactly what the business runs on with the legacy ERP system, spreadsheets, a lot of tacit knowledge. He also told us about the ERP migration that he killed. That was 10 years ago, running towards twice the budget, nowhere near half the outcome. He pulled the plug. And then he actually stopped even trying to replace the ERP and started building around it. We've been doing a lot of work for Frank and helping him with these ERP workflow optimizations. And something that I found really interesting in the conversation with Frank was he never asked which model anybody was using. Like, he just asked what it cost and who owned it if it broke. And in your opinion, like, is that the right instinct, or is he leaving something on the table there?
I have a clarifying question. When you say what model, what is that in reference to?
Like LLM model, like Claude versus OpenAI versus Fable and Opus. Like,
that's what I thought. Just wanted to confirm. For further clarification, is it just a question of wanting, like, expecting to be more prescriptive, or is it that he was looking for like recommendations and guidance based on their needs, and need to edit this in post, which is fine. I think just to hash up.
yeah. I'm just reading it over. I think just like an interesting insight that Frank wasn't focused on the specific model or product itself, but more focused on the price, that maybe there's more price sensitivity from the buyer side, and you kind of have to make more of a case for more of the higher priced. I don't know. We can also just pass over that.
Yeah, I'm not, I think that clear on the question.
Yeah. All right. So here's what I want your take on from the conversation with Frank. We talk about the 80-20 rule a lot, that, in software development, as well as in many areas, the first 80% is actually kind of the easy part. And it's actually the last 20% that ends up taking 80% of the time and effort and cost, and just getting to done is actually a lot harder than, getting started and getting the bulk of the work done. And that's this like 80% trap. And so Frank kind of experienced this with the ERP system, right? They attempted this ERP migration, didn't work. They bailed, a lot of costs sunk there. But I think he actually caught that a lot earlier than a lot of folks do, where he pulled the plug, and that project could have, still been going and burning budgets. He's now doing this ERP workflow optimization. And to me, it's brilliant, where you can stay with your ERP. You don't have to take on that cost, and you can make it a lot friendlier to work with. And it seems like he's actually flipped it, where he's found like a 20% expense way to get to 80% plus of the value. I'm curious, like, how you see that. Like, do you think there are this sort of unlock exists within some of these massive incumbent technologies, where you actually build around them instead of replacing them?
Yeah, I think it makes a lot of sense. And we've seen a ton of that. And I think it speaks to a lot of these platforms. They're generalist platforms that span multiple industries, and they're bulletproof. They pass muster from a governance and security posture. They're incredibly robust. But because they have to generalize, if you have industry specific needs, you have to either buy an industry specific module, which we've seen, and they're not always great. They're incredibly expensive, and they still might not be exactly what the customer needs. But what we're seeing is, because a lot of these systems have APIs and make the data accessible, exactly like what Frank's doing, because we can expose that data, we can then bolt on bespoke interfaces that are exactly what they need. And because it's either a subset of data or processes, it's a lot more efficient from a time perspective, from a cost perspective, but you're not reinventing the wheel. I mean, it would be pretty foolish to invent ERP from scratch. And if you're already using one and it's rolled out worldwide, you now have good governance with your data. But then if specific business divisions have niche needs, we can go and do our thing, and we're not trying to boil the ocean. And I think that makes a lot of sense for a lot of businesses. And I'd recommend they evaluate that versus either replatforming an ERP, which I think is a non-starter. In most cases, that takes years and millions of dollars, or just figure out what is my specific need and maybe do a discovery to figure out what the lift would be to solve these problems. And then again, they have access to all of the data that's already in the system. They're not having to build completely new processes or spin up a lot of new infrastructure. So I keep repeating myself, but I really agree with that approach. And we've seen it be highly successful on a number of engagements.
Yeah, it's how we map out like AI initiatives when we're talking with companies too. It's like, let's understand all your workflows and how jobs are getting done right now, and then look for the low-hanging fruit opportunities where you can have relatively low spend to get a ton of value back. It's interesting to me that oftentimes it results in indirect AI usage. That's not an AI project. I mean, granted, AI is being used to help build it and it will open the door to a lot of AI activities, but in and of itself, it's just another custom software build. But a massive low hanging fruit opportunity. All right, I'm going to transition over to some news of the week. We're going to start with our first story. Your insurance may have quietly stopped covering AI. This one gets me a little amped up. This went out this morning. We might actually be some of the first people to cover this, but insurance carriers are writing AI out of standard business coverage. 3 new endorsements strip generative AI liability out of general liability policies. Berkeley has gone further and put an absolute AI exclusion across its direct officers, errors and omissions, and fiduciary products. They're removing it because AI-related lawsuits are up 978% from 2021 to 2025, and we're up 137% in 2025 alone. So if you use AI anywhere in your business, in customer service or marketing copy, hiring, quoting, your next renewal may quietly stop covering what it does, and no one's going to call you about it. And that's what gets me frustrated. I think this goes, I'll give you my take on this and then I want to hear yours, but I think this goes one of two ways. Either the rest of the carriers are going to follow Berkeley and write AI out of their standard coverage. And now you've got companies telling their own people they literally cannot use AI because the liability is uninsurable. And that's definitely pumping the brakes on innovation that who saw that coming from insurers instead of board mandates, or the carriers who do cover it use it as a wedge and take market share, and then they charge a premium for that privilege. So your insurance coverage survives, but your rates go up, and you can add that to the pile of AI spend that no one's been budgeting for. So there's no version of this to me where it gets cheaper to use AI. There's like a tax either way, and it's either going to show up as a ban or as a bill.
I have a very meta response to this because it's relevant. Last week, I spent, I think, about 4 hours filling out an insurance renewal questionnaire. And one of the questions, or actually several of the questions, were about how we use AI. And it is now a very tightly woven component of our business. So needless to say, I answered the affirmative. I am curious to see what our quote comes back at now that question was introduced. Sounds like it's going to go up. The meta piece to all of this was they were asking for some fairly specific financial data that we have across various spots, mostly in QuickBooks, but it wasn't super accessible. And like any lazy agentic engineer, I took a look around, and Intuit does have a read-only MCP layer. So I put that in place, and that was pretty awesome. I could ask Claude. I had to jump through some hoops and get all my tokens set up, and it was relatively secure, but Claude got all of my questions answered for the insurance questionnaire. I did spot check them to make sure it didn't hallucinate. So that was wonderful. But to tie it back to this question, like that's the risk. If you're reliant on these tools for day-to-day work and it hallucinates and goes bonkers and people aren't checking the work, that's huge risk. So they're rightfully so baking that in. So I agree with you. It's going to go one of two ways. The easy one is no, you can't use AI either across the board or for these tasks, or they just have to have really disciplined and rigid practices put in place to ensure that work is checked. And if you are relying on it, you're exposing the company to risk by not double checking and ensuring there aren't hallucinations. And there's probably marketplace opportunity here for risk mitigation when using AI to put in guardrails and systems to reduce the amount of hallucinations and incorrect data that will then result in these lawsuits that you're insuring against.
Yeah, like the part that actually worries me here is that the companies that are most exposed to this are the ones that are least likely to catch it. So, like, if you're a mid-market operator without in-house legal and nobody on your team's reading the endorsements on your renewal, the changes just go through silently. But you keep using AI exactly as you did last week and think you're covered, and you're not. So, you line that up against these AI lawsuits climbing 137% in a year, the gap and the risk are growing, and people just aren't going to see this coming. Like, what would we do if you just fill out this form and they say, "Oh, you're not covered for AI"? I don't see a world in which we stop using AI.
No, we can't. We just would have that risk. We're not alone on this. Kind of scary times from the perspective of insurance coverage, for sure. I didn't think anything could outcompete the rates in which our health insurance goes up, but we're about to find out with our business liability insurance and the AI clause. My hunch is they'll carve out separate policies for AI. So you might have like core business risk insurance, but if you answered the affirmative that you use AI, then it's a supplemental, because maybe they'll get market pushback or folks stop using it and they have to think of creative ways to mitigate their risk, but also collect the premiums to cover it. I don't know. It's going to be an interesting year in that industry, and curious to see where it all shakes out.
Yeah, leave it to insurance companies to ruin everything. All right, second
Yep.
story. Silver Lake's in talk to take Workday private. If it closes, it would be one of the largest software buyouts ever done. The stock jumped 18% on the news. The logic, according to the reporting, is that the big systems of record are actually safe from AI. They're embedded, they're hard to replace, and they're sitting on data you can do AI things with. And a number that ties it together here, software prices are up more than 17% year over year. General inflation is running 3.4. So software is inflating at 5 times the rate of everything else. And a lot of that increase has an AI label stapled to it, whether or not you're using it. I'm going to start with my take first. Sorry. But I agree with the core of this. I'd push it maybe a level deeper. Everyone hears these like systems of record are AI proof and assumes that maybe that means that AI can't touch them. I think it actually makes the data in the system of record a lot more valuable, but it also makes the interface on top of it worthless. Think about how you actually work now. I'll just speak for myself. There are a half dozen tools that we pay for at Gnar that I use at least weekly, if not daily, and I never log into them, like Google Analytics and AirOps and like so much of our marketing spend in particular. And they've all got dashboards and UIs, and I literally never use it. I just connect to it and query it through Claude. The value never was the interface. It was always, the data underneath, and the connector is what allows you to access to it. And so I've talked about this before, but that's the like interface consolidation that I keep coming back to. The app layer is going to collapse to one place you actually work, and the systems of record and things feeding it. And I think, that's why private equity wants them. We saw with like the SaaS apocalypse, their values getting eaten up, but the system of records being, more valuable. So I think this is kind of just private equity trying to squeeze as much as they can from the assets they have that are still valuable, because a lot of their portfolios are kind of declining in value, and they need the winners to kind of carry the fund.
Yeah, that tracks my line of thinking. I think it's a platform / ecosystem play where you have these big enterprise platforms that are like incumbents in the marketplace, and they're now cheaper than ever to operate and maintain too, because you can be more effective with fewer engineers using these tools. And like how it pertains to the SaaS apocalypse, I think we're going to see, what's the word I'm thinking of? Stratification in software, where these really big enterprise platforms, ain't nobody vibe coding one of those in a weekend, nor would an enterprise company adopt those. So I think there is a moat there. Can't take it for granted, but I think it makes sense for PE to target these and feel like there's some insulation in the marketplace from someone coming in there. But where the stratification is on the smaller side, you don't have a moat because your SaaS product can be vibe coded in a weekend. That's where the real risk is. And we're going to continue to see a decline in investment in VC funds in that realm. And that probably speaks to why, and I'm way over my skis on this because I'm a software engineer. I'm not in finance, but I think that these large PE plays there's a lot more dollar volume moving in those than what historically we saw a decade ago in the VC space with these moonshots, because it's a lot more competitive in that realm.
Yeah, I wonder if we're just going to start seeing a lot of investment activity around incumbents and proven players in these systems of record, and not a whole lot else happening.
Yeah. I mean, we'll still see innovation, but it's just going to be at a different scale and in different areas. But that is something to think about in the future. Like you said, the interface, right? Where literally the example I said 2 minutes ago, where I don't even need to log in the QuickBooks to get a P&L. I can literally say, Claude, give me my P&L. And I think we're going to see more and more of that. We see AI to BI, and I think that's going to erode a lot of the interfaces to BI systems. But it's going to be an interesting next few years for how that evolves to a whole other episode. But we're seeing it every single day right now.
All right, well, let's bring this into our main topic, and that's the AI bill that nobody budgeted for. I'm going to put a few numbers on the table here, and then Nick, we can discuss and we can determine why maybe they're not as damning as they sound. But the first one is 0. And that's the study from this morning that out of 150 leaders, none of them reported cost reduction from AI. 2/3 reported costs going up. 60% are running 7 or more separate AI platforms, which is crazy to me. 29% have formal governance structure. We had a separate survey of 396 companies, and 50% of them had to escalate a surprise AI bill to their board. And then the third one, this is the one I can't stop thinking about. Apollo's chief economist broke the AI industry into layers. The chip and equipment makers are running a 41% profit margin. The companies selling the models and the apps are running a negative 59% operating margin. The profits are being funded by investors, not earned from customers. There is a fourth thing, because I don't want to just stack doom here. 2 items landed this week that cut the other way. Anthropic, the company that makes Claude, the models that we run all day, just posted its first operating profit. There's some questions around how it was calculated, but it was reportedly, a couple of years ahead of when anyone expected it. It started earning from customers, not just from investors. It's been big in the B2B space. And then DeepSeek, the one everyone held up as proof that AI would be dirt cheap forever, just raised its API prices by 4x. And so Cam had an interesting take that AI was being priced for customer acquisition right now, and expected that to shift. I think maybe that shift is starting, and the subsidized era is maybe ending. But here's like the optimistic read. The reason nobody could control this spend is that nobody could measure it, and there's no real way to see it. And that is changing. And the moment companies, this is my take, the moment companies can actually measure what they spend on AI, they can put controls on it the same way they did with the cloud. So some of these numbers are ugly and that could turn around, but not because maybe AI gets cheaper, but because companies like get to manage it like a line item instead of a mystery bill that shows up. I don't know. It's pretty rambly, but feel free to push back on any of that.
We touched upon some of this earlier. Again, I think a lot of it is measurable. And the number that helps me justify our AI spend is, when we rolled out our AI fluency course internally, we do have really good velocity metrics on throughput. And after running the team through it and really leveling up everyone so that they're on the same page in terms of our AI SDLC, you got, what was it, 41% increase in story point, or I might be messing this up.
It was
And
43% improvement in tickets being
Yes.
closed and a 93% improvement on story points completed per week. So it just means that our team is working on a lot more work and more complex work.
Exactly. And the fact that we had those tools in place make me feel a little bit better about our 5-figure Anthropic spend. And I think that's part of it. Very few orgs likely have the ability to do that. And I think there's huge opportunity. It's tricky though. I mean, we don't want to live in a dystopian world where every single thing you do is being tracked and measured against AI efficiency, but you need some metrics, or maybe it's simpler, more tied to revenue savings. I don't know, but I think that's the gap, because AI is just going to go up and up for some time. And if you can't justify it, that speaks to these numbers. The piece about chip makers making it rain and the operators not doesn't surprise me. I'd like to think that's going to go down. I mean, this is a slippery slope about, build out all of the data centers and scale will reduce that. Might have something to do with it. There's a whole other bunch of variables that I'm not anywhere close to being equipped to handle, but I would think over time that number is going to go down. With that being said, I think AI spend is going to continue to go up. You're just going to need to justify it, but it'll be interesting to see. For a while, I was really gangbusters on Google and Gemini because they developed their own CPU chipset as opposed to running the models on GPU, which is a lot more efficient. So in theory, that should cause costs to go down. We're not seeing that yet, but I think as the hardware improves and memory prices level out and things of that nature, hopefully we'll start to see those costs go down and then companies get more sophisticated with the reporting.
Yeah, and there's two kind of talking points I have on this. One is that there's some real wonkiness going on between the chip makers and the companies that make the tools and the LLMs. Like, the most recent one that was a head scratcher to me, or just a sign of like, there's something weird going on here, is that NVIDIA just invested a ton of money. I think it was like maybe $100 billion, or like just a crazy amount of money in an open AI data center in order to be like the exclusive hardware provider to that data center. So that they're paying OpenAI a shit ton of money so that OpenAI can pay them a shit ton of money for their chips. Like, it's super weird and cyclical and incestual. So I'm not smart enough to know much about that. I've seen people say like that's a sign of, a bubble or some impending doom, but it's weird to me. The other piece to this is that, this is kind of a doomy or gloomy take of no no leaders out of 150 reporting a cost reduction from AI, that doesn't mean they didn't get outsized value from that investment. Like there's nothing on the other side of that. Like we have, I actually don't know if we have increased overall spend, but we spend a ton of money on AI and it's only going up and up, but we continue to get, I would say, outsized value for the spend. So I just think that's like a missing piece to this.
Yeah. I'm going to botch the pronunciation, but the sort of meme about hardware investing in the providers is it Ouroboros, which is the snake that eats its own tail. An article that referenced that.
And so, like, why do you think this bill is invisible? It's not like these companies are not tracking spending. They're tracking everything else. Why is it that they're unable to get a handle on this spend?
I'm looking at it from the lens of my experience, and let's put your average software engineering shop under a microscope in that regards. They would need granular metrics on sort of a before and after, like velocity, to calculate improvement. And it's a very inexact science. And then they'd have to also have better ways to quantify token spend. And we've already surfaced, it's not great. You can't get good specifics on per user token spend tied to specific projects. And engineering shops have some level of sophistication. Let's then think about, I don't know, a sales department who might be using it for pitch decks and things of that nature. Their effort tracking is orders of magnitude less than what's likely available in an engineering shop when you get into the non-technical departments. So I think it's really hard to calculate the sort of per user, per seat efficiency gains across an entire org, especially one at scale. And it's probably going to be its own cottage industry at some point. Totally speculating, but we're seeing that. So I think that's certainly a big factor. And I'm sure there's more macro level ones I'm completely glossing over, but those are some real world examples that we've seen.
Yeah. I mean, I think a piece of this, like you touched on, is like the tooling it generally doesn't exist yet. It's starting to, and there are some big players that are scrambling to be the first ones here because I think they're seeing the massive opportunity. Cloud Zero rebranded around this. Ramp is coming at it from the corporate card side. I think the products are just a little bit behind, or the tooling's just a little bit behind the billings, I guess. Let's see. All right. Say I run an 80-person distributor. I've got Copilot licenses. Someone's paying for ChatGPT on a company card, and a vendor just told me their AI feature is why my renewal went up. Got no telemetry and no appetite to build any. Where should I start?
Oh no. What can you really do there? I mean, we've seen that. Like AI integration is table stakes for most projects. So they're all bolting them on. Most of them suck. Yet they have to incur those costs because they're proxying their chat wizard that's specific to their product over to Anthropic. Someone's going to eat that. It's a tough position to be in, right? Because
Yeah.
you need AI, but do customers want to pay for a half-baked feature? Probably not, but they still need your product.
I mean, that's like every SaaS company's grasping at straws right now, just throwing in an AI chatbot so they can increase their pricing, and it's all garbage, or not even garbage, just some of it's valuable, but it's stuff you could do off their platform too. It doesn't need to be baked in. But my response to this person would be, change your attitude. I don't think it's okay to say like, I've got no telemetry and no appetite to build any. Like you need to start somewhere. You need to map out, the jobs that are getting done and how AI is being used or where your spend is going. You need to have some grasp of it. You can't just say, where do I start? I don't want to do anything. It's just not realistic.
My snarky response is more around seeing a SaaS product they use, the monthly bill get juiced because they don't want to eat the AI spend. But I think you covered the broader issues. The easy solve for that for SaaS companies is enable bring your own key so that folks can use their own Anthropic keys and not have to pay more for a feature maybe they don't want, or allow them to disable it. Don't feel like you have to have it enabled and you have to incur all of the LLM spend on something that maybe your users don't want or need.
Yeah. These, sorry, what's the term for it? We were just talking about it. Sorry. Do you think there's a world in which more of these systems of record get built internally? Because a lot of them are not complicated applications, but with vendors increasing costs or systems of record juicing the pricing, or these other apps that are adding, some rudimentary AI add-on and charging more money for it. Do you think there's a world in which people just say, I've had enough, I'll build it myself? I mean, it's kind of what we've seen with GIC.
Yeah. And I think it speaks to like that stratification layer where they still might be beholden to their enterprise platform and they'll need to pay that, say their ERP, but they can build a custom interface or workflow on top of that. I think we're going to see more and more of that. And then for the smaller, more bespoke tools, we're already seeing that, or they'll just hit that threshold where it is now cheaper for me to build and operate this than pay you an ever increasing amount of money because you're adding features that are costing me more money that I don't want or need. I'll just do it myself.
Right. Well, I mean, what if the ERP shuts off its API, right? Says we're not maintaining our API right now. We're not doing anything else for it. Like, we want more control over the workflows or whatever else. I mean, at that point, do you say, I'm building my own?
Perhaps, or maybe the marketplace will speak for itself where there's an alternative out there that does make that data accessible and people are like, okay, see you later. I'll go with this open platform that allows me to operate my company. It could happen. I mean, I think we've seen that even in the pre-AI days where you had these platforms that were more open and extensible and were able to get users because of that. They could start to integrate more easily and they didn't have to purchase all of these modules that weren't nearly as good as other solutions or other vendors. I mean, only time would tell, but I could see that as being a good competitive advantage for new players in that space to speak to the needs of an MCP layer and API layer if some of the other companies get it. I think we'll probably see a middle ground where it's still available. You're just going to pay more.
Yeah, right. And I hope what you're saying is the direction that it goes in, that they actually make it easier. They see that they can just be the system of record and have more market share just by being that, but providing those connectors. I worry that there might be more ERP migration projects in the future, but time will tell. But that's the episode. If you've been buying AI on faith, this is the week to go find the invoices, count the tools, time one job, pick an owner. You don't need a platform to do any of it. You just need an afternoon. And if the number comes back ugly, that's not a failure. That's the first honest number you've had. Two quick things before we go. First, our AI for Operators series. It's built for exactly the operator we spent this whole episode talking about. Details and sign up are in the show notes. Second, next time, never mind. We have a producer note. Okay, sign up. If today got you thinking about your own shop, we built a free 2-minute AI readiness assessment that tells you exactly where you stand. It's at ai-assessment.thegnar.com. The link is also in the show notes. Until next time, stay curious, make sure you stay sharp, and we'll see you in the Gnar.